with Jason Schenker, President, Prestige Economics. Good morning, Jason, and welcome back to the show.
Good morning. Thanks for having me here.
Jason, I'd like to start with a very, very simple question. Does it make any sense to you, everything that happened in the past 48 hours with markets? From one side, we had the penny stocks surging. On the other side, the tech stocks getting hammered, and not only the Nasdaq closed down about 3.5% after Dow's record highs just in the previous day. So what's going on?
Well, I think this is the markets are shifting around. The inflation risk is finally being realized. This is something that was out there, has been out there, especially in the second quarter. The year-on-year rates of U.S. consumer inflation probably going to be around 2.5%. We've been expecting this for many months because in the second quarter last year, inflation was really low. What's happened is we've seen a lot of stimulus out there that has made money very cheap, and so people have chased yields. Junk bond yields last week were at their lowest levels in history. And if we look just a week ago, right, Bitcoin at record levels, copper, aluminum, oil, all high, equities at record levels. And now here we are a week later, and we're beginning to see some choppiness in the markets. Most of them are still near record highs. Some of them have moved up a little bit as well, but this choppiness is really because of the pricing in the bond market of more inflation. The move up in Treasury yields has resulted in a series of waves and reverberations across markets. And this could continue for some time because that specter of inflation is haunting markets in a real way.
So I was wondering, do we have to necessarily think about higher inflation when we see higher yields?
No, it's really the other way around. And, we've seen there's kind of two kinds of inflation. We've seen a lot of inflation in the last year, but it's asset inflation. The prices of equities, real estate, commodities, cryptocurrencies, almost any asset you can name, its price has gone up in recent months. And now the question is, well, what about the inflation that central banks care about? Because central banks don't target asset inflation, they target consumer inflation, which is a basket of goods that people consume. In the US, it includes owner's equivalent rent and food and energy and other things that people consume, not how much real estate is or commodity prices purely in the markets or equities. So we're seeing the risk that there's a bleed over from the asset inflation to the consumer inflation. That's the concern. And now we're beginning to see some moves in the bond market that really account for that risk. Because at the beginning of this year, the U.S. 10-year Treasury was less than 1%. That means if you bought U.S. Treasuries, a 10-year Treasury, on January 1st of 2021, the yield per year for the next decade was going to be less than 1%. Now that's moved up a lot, especially in just the last couple of weeks, but it's still exceptionally low. And investors want to yield more than 1% or 1.5%. And so they end up chasing riskier assets. And that's why we've seen so many other markets just absolutely skyrocket, because there's a lot of liquidity out there, and investors need yield. They want to make a return on their assets.
We were also wondering what's the risk that a Fed will react with a technical move, and also, do you think that the Fed is supposed to respond at these higher yields? Because you just said that even though we do see nice fluctuations even right now at one point in between 1.46 to 47 to 50, so you still say that yields are pretty low. So do you think the Fed is supposed to react? Because I shall say that the ECB, the Australian Central Bank, and also the Bank of England, they just spoke. The guy just spoke, have been pretty clear. I mean, they are kind of saying we don't like what we see. So do you think the Fed is going to confirm the same, or it's a different story?
So I think there's three pieces here, and it is a different story in the U.S. First of all, in the United States, there are more equity investors than there are fixed income bond investors. That's very different than in most of continental Europe, where fixed income tends to be more important as a piece of investments and portfolios than equities. And that has a lot to do with defined benefits pensions versus defined contributions pensions, which have become so prevalent in the US. The yields are moving up because there's skepticism that the Fed will be able to keep rates low as long as they say they are. As recently as December, the Fed released a series of forecasts for interest rates, and their forecasts are that Fed rates will be between 0 and 0.25% through at least the end of 2023. So into 2024, rates near zero for that long really risks putting a lot of heat, more asset inflation. And that's what folks are kind of concerned about. Will the Fed raise rates? No, that's not the response to this. Especially right now, you look at the January consumer price index, that's US inflation, it's 1.4% year on year. That's the most recent data for inflation. So the Fed really doesn't have a justification to raise rates with inflation that low. Now, when the second quarter comes, we might see a change of guidance. We might see a change in their quantitative easing policy. But for now, the Fed is still buying treasuries, they're still buying mortgages, they're still expanding their balance sheet, and they are still scheduled to keep rates near zero for years. The issue is the bond markets are becoming a bit more skeptical about this because there's inflation creeping up in the months ahead.
I'd like to talk about the jobs market, the labor market. Yesterday we saw a little bit of data. It was better than expected. So what's your take? And do you think that the actual unemployment rate is between 5 and 6% or it's way higher?
So the actual unemployment rate is probably very close to 12% in the United States right now. There's a problem with the way some of the people are talking about data, the way the data releases come out, U.S. jobless claims. There are three really important numbers in there. There's the headline jobless claims number. Oh, that number went down a lot. Part of the reason that might have happened is because of big winter storms in the U.S. last week. The second number in there are continuing jobless claims. Now, initial jobless claims when you first lose a job, right? That was still above 700,000. The continuing jobless claims are people who are unemployed and filing to continue to receive unemployment benefits. That was over 4 million. But that sounds like not a big number in a labor force of over 160 million. However, there's a third number in the report, which is the total claims in all categories. So there are two new categories of unemployment benefit that were created because of COVID. These are pandemic-related jobless claims. If we add those to all the different claims, the most recent data we have for the ending of the first week of February shows that 19 million Americans were collecting jobless claims in the first week of February. 19 million, not 4. It's a much bigger number. And so if you look at the 19 million versus the 160 million labor market, you end up with almost a 12% unemployment rate. And if you look at the monthly jobs report that'll be out next Friday, there's a problem with the way the labor force is being calculated. There's between 4.5 and 5 million people who haven't been able to look for work because of COVID. They're not being counted in the labor force. But if you counted them in the labor force, you'd have to count them as unemployed. So when you increase that labor force number and then you increase the number of unemployed, you end up with an unemployment rate that's around 9.5%. So if you're looking at jobless claims, unemployment's close to 12%. And if you're including those folks who are not looking for work because of COVID, you're actually looking at a number that's closer to 9.5% because there's also a misclassification with some of the data. So there are some data problems depending on what report you're looking at, but no matter what the headline number is next Friday, and it might be 6.5%, that's not the real number of people who are unemployed.
Still huge numbers, really, really huge number.
Even 6% is a big number, and that's close to sort of 10 million, but they're not counting another 5 to 9 million of other unemployed people, and that's just the way the data is collected. But those people are there, and they are unemployed. So
the House will be voting Biden's $1.9 trillion relief package. There is a huge discussion. Some economists and analysts are arguing that the price tag is too high. Republicans didn't like the minimum wage proposal. They totally, shelved it. So what's the right size in your opinion, and do you think it's going to be downsized? Because how important it is for the United States in this $1.9 trillion relief package. Do you think this is what America needs right now, talking about labor market specifically?
Well, look, there are 19 million unemployed Americans out there, so we shouldn't be surprised that there's discussion of more fiscal policy stimulus, or that the Fed wants to keep rates near 0% for years, right? That's a serious problem. At 12% unemployment rate, that's a monstrous number. So we shouldn't be surprised that this is going on. What parts of it actually get through, we'll kind of have to see. I think the minimum wage piece is something businesses are very concerned about. I think the biggest issue here, most people might not realize, is the jobs that have been most severely impacted by COVID are low-paying service jobs. That means if you're an employer and you have a business, because right, that's where these private sector jobs come from, if people are working for a business and that business hasn't operated for the last year, lost money for the past year, and now is going to reopen once we're past COVID, well, if now they have to pay a higher minimum wage to all of their workers, which would impact restaurants, retail, and the like, they might not hire as many people, or they might not reopen, and those jobs may not come back. Something most people don't realize is in the United States, if you are a waiter at a restaurant, you wait tables, the official national minimum wage for that, the federal minimum wage, is $2.13 an hour to wait tables. That's an absurdly low level, and that's because Americans tip when they go to restaurants, and that's where people derive their income. But if we now were to see businesses also raising it to $15 an hour, that's going to have an impact on what those businesses do. Now, what's right or wrong in all of that? I mean, I waited tables 2 recessions ago, so I know what it's like to make $2.13 an hour waiting tables. It's not great. How we approach this challenge, how we think about the trade-offs, is something that we'll have to see play out in the political space. There are no perfect answers right now because we have a job market that is in a really a horrible state even now, and many, many people will still not have their jobs this year or next year or beyond. It might take us many years, if not a decade, to get back to where we were before COVID. And while right now 19 million people are unemployed, more than 19 million, if we look before COVID happened a year ago at the beginning of February, there were only a little more than 2 million unemployed Americans. Right. How many years will it take for us to go from 19 to 2 million? That could be the better part of a decade.
That's incredible. Let me ask you one final take. So do you think it's going to pass? The package, of course. I'm talking about a relief package.
Right. So in the U.S., there's a House, a Senate, the presidency. They're all controlled by the Democratic Party. Something will pass through all of them. Right. What the final thing looks like, we'll have to see.
Thank you so much. Jason Schenker, President, Prestige Economics. Thank you for joining us. Have a great weekend.
You too. Thank you.